All right, so today I wanted to make a video on dividend growth versus just straight up dividend investing. Which one is better? And to me, it's pretty obvious, although some questions need to be asked first, in that the first one needs to be um, what's your time horizon, right? If your time horizon is right now, well, dividend paying stocks is going to be your best bet. But if your time horizon is anything more than 5 years, maybe even less, that your best bet is going to be dividend growth. And why is that? Well, the indisputable facts are dividend growth is always beat dividends over the long run, right? I mean, if you compare um, the VIG, the Dividend Appreciation Index, which is probably the biggest dividend growth ETF out there, to the, you mean, even if you take the Vanguard Dividend ETF, the Dividend Growth ETF is fairly easily outperformed it, not by a crazy amount, but fairly easily. And again, it's not a perfect example, but it is an example. But if you look at just individual stocks, right? I mean, let's take CN for an example, right? Currently only paying a 1.86% dividend. But if we go back over time, it's a company that's growing its dividend by 11.34% per year, right? Over the last 5 years. So if we go back 5 years, you're looking at a 3% dividend, right? So the dividend's almost double what it was then. If we go back 10 years, we're looking at a 4.3% dividend, right? Let's go back 15, right? If we go back 15, we're looking at a 8% dividend, right? If we go back 20, right, we're looking at a company that's got a 25% dividend, right? So the key when it comes to dividends is, in my opinion, you want to invest in companies that are growing their dividend, although some other things are very important as well. When it comes to dividend growth or dividends in general, number one, you need to make sure that they are actually going to be able to pay that dividend, right? So you want to look at their payout ratios, right? Are those excessively high? Because if they're above 75, 80, 90%, then the chances, I mean, if all they need to see is a little bit of problems going on, and that dividend's not going to be sustainable, right? So you want companies that have a healthy payout ratio that are going to be able to continue to grow it in the future, because if your goal is the long term, you want that payout ratio to probably be below 50 or 60%, unless they're a company that's growing very fast, right? But if they're growing very fast, they probably should be investing the majority of that cash flow into growing the business rather than paying a dividend, right? Now, preferably you do want both. You want a combination of, I mean, in my opinion, the perfect company is one that's growing steadily, it's buying back shares, and it's growing its dividend, right? If you can get a company that's growing its dividend by 5, 10% or even more, that's also buying back shares, that's also growing above the market average, that's the trifecta, right? That's the perfect company, in my opinion. Another important thing, too, you want to look at, especially in times like today, is companies that have good earnings yields, right? That is essentially if they wanted to pay out 100% of their earnings as a form of a dividend, how high would that number be? Now, you want that number to be above the 10-year treasury, right? The 10-year treasury, it's around 4%. It touched about 4.2% recently. And the reason for that is if you're an investor, especially these bigger hedge funds and mutual funds and whatnot, if you have cash to spare and you can get a guaranteed 4% on a 10-year treasury versus roughly 4% on a stock, you're going to probably pick that treasury on average, right? So in times like today, you want companies that have very strong earnings yield, right? Nowadays, you're going to want that to be minimum, probably 4% at the absolute minimum, unless they're growing insanely fast or are very cheap. Preferably, you want that number to be over 5%. If you can find companies in the double digits, that's going to be a really good deal. Um, but again, getting back to the main point here, another big problem with a lot of these dividend funds is that to achieve returns comparable to the overall market. And again, if you look at the overall market where you're returning 8-9% per year, you need to be getting an 8 or 9% dividend. The problem with a lot of these companies is that's not sustainable, right? I mean, if you look at some of these higher, let's take NLY, Annaly Capital, they're one of the bigger, I believe they're a BDC. Over the long run, their stock price is losing money, right? This is the problem with a lot of these really, I mean, they got a 21% dividend, right? People look at that and say, hey, they got this crazy high dividend, they must be good. But again, you need to look at the stock price returns, right? Let's take AG&C. This is another popular one here. Again, another company that again, 18% dividend, but their stock value is losing, right? So this is the problem, is that if you're going to invest in dividend specific, whether it's a BDC, a general stock, ETF, doesn't matter, mortgage REIT, you want to make sure that that stock is not losing value, because if the stock's losing value at 5% a year, but you have a 10% dividend, well, you're actually getting 5%, right? So that's the key, right? I'm not saying that dividend specific investing is not good by any means. What I am saying is that you need to be very careful with any form of investing, right? You need to be careful because there's a lot of garbage out there, right? I think this is something that a lot of people, me included to a degree, have learned the hard way, is that there is a lot of garbage out there. I mean, if you're looking for a more, again, in my opinion, everything here is my opinion, obviously, but a more consistent, you want to look at like an Ares Capital, right? Again, go back 5 years, they are up. I know they're up. Not by much, but they are up. Again, 9.65% dividend. Again, not you're not going to destroy the market, but again, that's what you're actually wanting to look at, right? Main Street Capital, another solid one in my opinion. Only a 7.6% dividend, but I mean the share price is pretty flat, but they're one of the more popular BDCs out there, I know. Gladstone Investments, another good one in my opinion. 7.67%. They're not necessarily down, although they are down quite a bit on the year. So that's what you want to look at, right? When it comes to either form, if you're going to go with the dividend route, make sure that the payout ratio is sustainable. Make sure that the share price isn't going down. Also, make sure, I mean, you want to look in the future too, because some of these companies, yeah, they might be looking okay now, but are they going to be looking okay in the future, right? That's another important thing to look out for. Again, also when it comes to some of these stocks too, what do the payout ratios look like? What does the earnings yield look like? And again, what is the future outlook? Because there is some of these companies that, yeah, they're growing their dividend nice, but are they going to be able to do it in the future? Again, this is why I like a company like CN, right? They're not sexy by any means, but they're like, this is a company that's going to continue to, I mean, see, like, does anyone really think CN's not going to be around in 10 or 20 years? Like, of course they are. And I would be shocked and appalled if they haven't grown during that period, right? Again, my personal opinion, but that's what I believe, right? So anyway, this is a big debate you see, and I think that this is another mistake that younger investors make. Going back to my last video, um, and investors as a whole, but I think this is something that everyone struggles with, is that people try and chase yields, right? They try and chase. They see these companies with these sexy double-digit dividend yields, and they think that, oh, this is gonna be the key, right? I'm gonna beat the market, right? But again, you need to make sure, like I said, is that dividend sustainable? And even if it does look like it's sustainable, are they in a good industry? Is the share price steady? Right? So there's a lot of other factors that need to be concerned. The dividend yield in and of itself is nowhere close to the most important thing, right? So anyway, that's what I wanted to bring up today. If you like the video, hit that like and subscribe, and stay tuned for more.